All right. So you've been looking for a house and you're previously qualified for $500,000 with an interest rate at 3% or below. What you really got to ask yourself, and if your lender's not already talking to you about it, is can you still afford that home? With reports of interest rate rising daily, and now county assessors raising real estate taxes, the debt to income ratio is one of the items that you must take very seriously and pay very close attention to if you were already maxed out on your loan value. And that is what today's video is all about. Are the days of cheap mortgages dead? If that's something you're interested in, stick around. You're going to want to watch this video. My name is Josh Barnett. I work at eXp Realty, and the team of agents that I work with at eXp Realty and we're here to absolutely help you with your housing needs. If you're relocating to, moving to, or moving within the Oklahoma City metro area, the state of Oklahoma, or even nationwide, we've got team members throughout the nation in our upline and our downline and at the international brokerage, eXp Realty, that are here to help you. So don't hesitate to give us a call, shoot us a text, send us an email when you're relocating to, moving to, or moving within the state of Oklahoma. All right, guys, let's get in today's video. Are the days of cheap interest rates dead? Okay, let me do a screen share with you real quick. So the biggest thing that I want to point out to you when you're talking about interest rates, and this is from Google, and I'm not a lender, so verify everything I say with your lender. I'm a real estate salesman, and I want to bring to your attention something that's very important right now for borrowers. When you're getting a loan, one of the things they use to qualify you on your loan is your debt to income ratio. So if previously your debt to income ratio, and according to Google, the maximum debt to income ratio for a conventional loan is 45%. Now, exceptions can be made for debt to income as high as 50% with strong compensating factors like a high credit score or a lot of cash reserves. So something to keep in mind. If you were previously approved for a $500,000 loan and one of the max factors was your debt to income ratio, that means you may not be qualified for that $500,000 loan anymore. Let's jump over to the calculator so I can show you what I'm talking about. When you're looking at the calculator, previously your interest rate on a 3% loan for 3% interest rate on a $500,000 loan you would have been paying $15,000 annually in interest, the rent for the use of money. Okay, so previously rates 3%. Rates are climbing. Looking at Fannie Mae right now, rates for April are 4.98%. So that's a 2% gain. A 2% gain. So if you were previously approved for 3% or below, now you're looking at almost 5%. So let's toss that in the calculator. A 5% interest rate on a $500,000 loan puts you at $25,000 annually in interest. Keeping in mind, the debt to income ratio has to be 45%. So if you are already maxed out on that debt to income ratio, to keep that ratio at 45%, the lender has to lower the amount of money they're able to lend you as a buyer. Okay, they've got to lower it to stay within that 45%. So how much do they have to lower it? Well, looking at that $10,000 difference, a $500,000 loan at 3% is 15 grand in interest a year. A $500,000 loan at 5% is $25,000 in interest per year. So to keep your payments below the debt to income ratio, they have to lower the amount that you're approved for by the $833 a month additional monthly payment. So if you were previously approved for a $500,000 loan, to keep you within the same monthly payment range, to keep your debt to income ratio low, the reason they're having to lower the amount that they can loan you is to lower the amount of your monthly cost, total cost, by $833. By $833 a month. because they can't get past the debt to income ratio ceiling without adjusting the purchase price approved by your lender. So that's how the interest rates are affecting your buying power as a buyer. If you were on the fence 90 days ago about buying a home and you were waiting for the market to cool, well, now the buying power has just dropped that you were previously able to buy. It's okay. It's something you can deal with. It's not a big deal. You just purchase a home that's a little smaller or a home that's further out from the main metro. Because usually as you get closer to metros, housing prices typically increase. The more rural you go, the less expensive a home is typically. Verify with your real estate agent. The second thing that you really, really want to start paying attention to, and the news has brought this to my attention, several other YouTubers have brought this to my attention, real estate assessors, the county assessors, the ad valorem taxes, those county assessors now have caught on that housing prices have been appreciating at historically high rates, and now they're adjusting the market value at the assessor's office for your property. That also increases your annual property taxes. That additional cost is another cost that the lender will factor into. The lender's going to factor that additional cost into your debt to income ratio. So if the real estate taxes previously were around $6,000 a year and the assessor reassesses the home to the current market value, in Oklahoma, the county assessors have limits by county that they can't adjust a certain amount over, but they're going to be maxing out those limits. I believe in Oklahoma County, it's 5% limit for adjusted raising ceiling. They can raise it by 5%. So if it was $5,000 and they're going to raise it 5%, that's an additional $250 a year. Is that what that comes out to? I'm doing the math in my head real quick. Put down in the comments below if I'm doing the math wrong. So you'll want to pay attention to the assessor's tax rates increasing also. Not only interest rates, but also the real estate ad valorem taxes. And then when we're looking at interest rates historically, right now, Freddie Mac is reporting a 4.9% interest rate in April. The last time we saw interest rates that high, looking at their calendar, was 2011. So that's the point of today's video. Are the days of cheap mortgages over? Relative to what we've been seeing, low 3% interest rates, some below 3% interest rates. Are they? That's the main question, and that's the main point of today's video. Guys, if you're in the market for a home, and if you're already under contract on a home, and you've locked in a great interest rate, you want to be very mindful of not going past that rate lock. You want to be very mindful of it. I'm a licensed real estate agent. I'm bringing this information to you as a buyer to help you out in making your purchasing decision. It's okay. You can buy a smaller home or you can buy a home further away. You can still get that dream home. It's still attainable. But these are things you want to pay attention to, especially if you're under contract right now. You don't want to miss out on that rate lock that you might have. Guys, as always, if you're relocating to, moving to, or moving within Oklahoma City, the Oklahoma City metro area, give me a call, shoot me a text, send me an email. The group of agents at XP Realty and I are here to help you making that move. Subscribe to the channel, hit the notification bell so you don't miss out on any of my future videos, and I'll see you guys on the next video. Oh, I got a new end of screen. Let me switch over to my new end of screen for you.